This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this week John Rubino, well-recognized author and publisher of the website dollarcollapse.com. Good morning, John.
Morning, Gord.
Well, welcome back to our second session this week. We're going to talk about Japan. John, a couple points before we get into the slides that you brought for our listeners. I don't think people fully appreciate that they're the biggest debtors in the world against GDP, and I have a chart here that shows their total debt is 512% of their current GDP, and the sovereign debt is 226%. Now, they've been able to finance their debt because it's domestically funded and they've had a positive balance of trade. But things have changed in the last year quite dramatically. And just recently, I have a chart here showing on the left that the IMF was out warning stringently that Japan and Spain, their debt was unstable, as they called it. I would use the word unpayable and inextinguishable, saying the magnitude of what the problem was there. And you can see on the right, we were talking the other day about Cyprus and the peripheral countries. It stands out as being inordinately high compared to them. We'll get into some of the changes that are happening and that allowed Shinzo Abe, the new prime minister, on December the 16th to be elected prime minister based on a monetary policy. I've never seen anybody win an election almost to the effect of threatening to take over and nationalize the Bank of Japan unless it moved to a 2% inflation targeting.
Yeah, here's the background story on Japan in a nutshell. They had twin bubbles back in the late 1980s in real estate and equities, both of which burst in the early 90s. And instead of just letting the bad debt be flushed out of the system, they tried to prop up the banks and the builders by borrowing a lot of money at the central government level and using that money for stimulus programs. And that worked to the extent that the banks didn't cease to exist, but it did not result in a vibrant economy. So the government had to continuously borrow from then until now. And in that time, they built up, as you said, a bigger sovereign debt as a percent of GDP than anybody else in the world, bigger than Greece, bigger than the U.S. You know, name the badly run country. Japan dwarfs their debt pathologies, and they've been able to get away with this because they had a lot of internal savings. Japanese families tended to save 20% or so of their income, and they used that money to buy government bonds at low interest rates. So they were self-financing. They also ran a trade surplus. They sold us more Hondas and Toyotas than we sold them, whatever it is we sell them. And so they had a lot of new money coming in, which also helped finance their deficits. Both of those things are done now. The population is so old that retirees are starting to outnumber workers, which means they're not saving money anymore. They're actually spending money. And they're beginning to run trade deficits now. This last report was a big, serious trade deficit in February for them. And so that means they can't self-fund anymore, and they have to borrow on the international markets. And there's a hedge fund manager named Kyle Bass who's been making this case really compellingly. And according to his calculations, if Japan just has to pay, on average, what the U.S. and Germany now pay for their debt, their interest costs will exceed their entire government tax revenue, which means they're toast. You know, there's no way you can run a country when all of your money and then some goes to pay for interest. And that time is coming in the next couple of years for Japan. It's that close, and it's completely unavoidable. There's nothing they can do about it. So the only question with Japan now is, when do they blow up? When do we figure out this is true and refuse to buy their bonds at 5% or 10% or whatever? You know, we demand a much, much higher interest rate, which sends them into a death spiral. And according to Kyle Bass, this might come in 2013. It'll definitely come by 2015, but it might come sooner. So Japan, it's out of the news now because of Cyprus, but we should be paying very close attention to their finances going forward.
I've said quite some time, a year now, that Europe was only the front runner. The real explosion will come in Japan. And I still believe that. I believe the big seminal event that will bring in a fiat currency crisis of the magnitude I'm expecting will center out of Japan. But I think there's a whole game that's still in front of us, John, because nobody's going to buy their bonds. But right now, I believe they're going to lead the charge to overt monetary financing, OMF, and that is out-and-out monetization of the debt, not even selling bonds to support it. They're going to print, well, they're talking about a quadrillion yen into the market. They're talking about trying to drive the yen down by 40 to 50%, which they have to do because these trade balances, they're hitting record lows right now. They're just uncompetitive. So they've got to get the yen down, and the magnitude of money that they're going to print, money that will flow into U.S. treasuries and into the ECB and has really helped the ESM triggering a carry trade, that'll buy them some time. But that says when the bomb blows, it will be serious because, now they're just totally out of control.
And this is absolutely to be expected. This is exactly how it works. When a country runs out of money, they realize that their last hope is to lower the value of their currency to the point where their debts are less onerous and their trade balance becomes more positive. In other words, if your currency is cheaper, the stuff that you're selling to the rest of the world is cheaper and you sell more of it, you have more money coming in, and that buys you some time. And in Jip Rickard's book, Currency Wars, he traces the history of these kinds of events, and it's happened before. And we're adhering to the script really closely here, where one country runs out of money and devalues its currency. That hurts its trading partners, who then do the same thing. And now it's Japan. They're the epicenter of the current currency war because they're the ones who are in the most immediate trouble. And like you said, they've got to knock their currency down by 30 or 40 or 50% going forward to have any chance of survival. And they can do that. You have an unlimited printing press, so you can create as much new currency as you need to. So technically it's possible. But it raises a couple of questions. One is, why would anybody hold yen or lend any money to Japan in those kind of circumstances? And if that doesn't, if we make the rational decision and refuse to give them any money, they have to finance their entire deficit going forward. And two, how will the other major trading nations respond? And obviously we'll have to respond by pushing down the value of our currencies. So the yen goes down, then the euro and the dollar drop, and that wipes out the yen's advantage, which puts them right back where they started, except with an awful lot more currency sloshing around out in the world. And so the crisis will recur. This is no kind of fix in the long run. It's strictly a way to get through the next year at the cost of a bigger crisis in the future and at the cost of pulling the rest of us down too. We in the U.S. are making mistakes that are just as big as Japan's, and so we're going to end up in the same place. And the only question is, who hits bottom first? Right now it looks like Japan, but there's no guarantee. We could get more aggressive monetarily here and get out ahead of Japan and be the ones who crash first. But somebody's going to at some point in the not too distant future.
Well, we beat up Japan pretty badly at the G20 meeting here recently when ABE showed up, and they were saying, look, you're precipitating a currency war, and this whole discussion of just completely debasing your currency is unacceptable. And they pounded on him hard enough that when he went back to Japan, he now talks about we're just doing 2% inflation, targeting what we wanted immediate and in 2 years. And so he's toned down his rhetoric, but it's very, very clear that he's on the front edge now of a new currency war, as you correctly point out. In driving it down, the rest will follow and have to accelerate. The reason you can't print money is because you just destroy your currency. But we're in a different game now. All of a sudden, we're in a game where they got no choice but to do outright monetization. But it kind of works. When your currency goes down, somebody's got to go up. So what's happening now with the currency cartel, and that is, and I say that, 90% of the world's currencies traded either in the yen, dollar, the euro, and the UK, and all of them are out and out committed, in my mind, to debasing their currencies. So as long as they all debase together, where do you flow to? What currency is going to go up? So I think that they're committed to debasing together in a coordinated fashion, which allows outright monetization of debt. The problem is you've got Russia, you've got China, you've got other countries that are saying no, no, no. So right now I see very soon a very strong reaction from China and Russia against Japan, because they've effectively starting a trade war to be able to get a competitive position. So they kind of got a gig going here as a cartel, and as you know, we call the OPEC a cartel because they coordinate prices. Well, we've got a cartel now going because they're trying to coordinate the pricing as they debase. But I think that the big issue is going to come out of China very, very quickly. And I've noticed, the last point I'd make, John, I've noticed that what China's been doing now is opening up these renminbi hubs so that they can have more free exchange. We talked a while ago about the trade agreements so that more and more dollars trade can be conducted not in the United States dollar, not using the petrodollar. That is a discussion in itself. But now they're opening up the centers. They had one in Taiwan. They're opening up one in Singapore. They're also talking about one and have made arrangements for it in England, in London, so that all of a sudden the renminbi is becoming much more liquid, and we're seeing more gold purchases. So at a point here, they could do a partial gold back. And I've noticed that the BRICS as a group, as a consortium, are now talking about a BRIC bank having increased levels of gold. So I see a threat that's looming here in this currency wars very quickly.
Yeah, Gordon. Okay, you nailed this. The countries that are being victimized by the currency war between Europe and the U.S. and Japan are fighting back by accumulating gold on the one hand. You know, their currencies are strong enough to allow them to buy gold fairly cheaply and accumulate a big balance. And by doing various things to make their currencies more acceptable for international trade. And the goal out there, maybe it's just as an insurance policy, maybe it's an explicit goal with a timetable, that nobody knows. But the ultimate goal is to have the yen or the yuan and the ruble and maybe several other currencies be internationally traded and then backed by gold in a world in which the yen and the euro and the dollar aren't the main currencies anymore because they've been destroyed by their governments. So you could see something like that happen 5 years from now or 10 years from now, where China and Russia create a joint currency backed by gold with complete convertibility and complete transparency. And who in their right mind would want to use another currency if that's what you get, you know? And they would instantly become the world's reserve currency. And the dollar and the yen and the euro would become secondary currencies, and our economies would suffer accordingly. We wouldn't have reserve currencies that we can print in unlimited quantities to buy big military budgets and everything else that we buy now. We'd have to live within our means. So the result of that would be catastrophic for the countries that now run big deficits, because all of a sudden we'd have to cut, you know, in the U.S. we'd have to cut $4 trillion a year out of our spending if you calculate our spending correctly. And there's no way we could do that without civil war. So the world 5 years hence, if we keep up with the currency war, is going to be very different from today's world. And it's going to be really, really unfavorable for us and the Japanese and the Europeans.
Sequestration, we barely got 60 to 80 billion, and we couldn't even do it. Never mind trillions, right? I mean, it's absurd that we could even begin to do it. You know, the other day we were talking about Germany and Cyprus in a discussion, and we said that basically Germany's been doing vendor financing with the peripherals. And now we also talked about them trying to convert monies into more hard assets versus just euros. China is a perfect example that they've been doing vendor financing for years, and they're beginning to do the same thing. They want out of the currency, and they're doing the indirect exchange. And the money that I see investing they're doing in infrastructure in Africa is stunning, and the Comdol countries. And what they're effectively doing is trying to unload U.S. dollars into real assets, because they see that day coming. I don't think they want it now. They're not in any rush for it. They want them to slow it down because it just doesn't help them right now. They need a global economy that's still booming, and it takes a 70% U.S. consumption economy to buy their goods. But we've got drunken politicians running totally out of control. And one thing I know, John, about politicians, they always take the easiest, most expedient way out of a problem. And right now, the most expedient, simple way out of the problem is to print the money. So, and to print the money when you can't issue bonds is just out and out monetization, which is a debasement of the currency, financial repression. They're already on that. They're just going to say more Kool-Aid.
Yeah, China would love it if this went on for another 10 years because, they would have insane amounts of gold, and they would own oil wells and gold mines and gas fields all over the world. And they would be in great shape for the transition away from the dollar as the world's reserve currency and towards the yuan. They would be ready. If it happened today, the transition would be tough for them, like you said, because we buy so much of their stuff still. And they would have to find other buyers for all of their exports or close down factories and accept the civil unrest that would come from that. They don't want that to happen.
See, that's the gun that's at their head. They've got 50 million people a year leaving the country, going to the cities, and the government has one responsibility in China, and that's to supply work. And you've got the factories that don't need as much labor, and the high labor content's been moving to other areas as Chinese labor has risen up. And you've got the advent of robotics and lights out factories, all sorts of advancements in manufacturing that is stripping jobs away. Schumpeter's mass creative destruction. But meanwhile, they've got 1.3 billion people that want to move into the middle class and 50 million looking for jobs and a 250 million transient labor force. And I can get into Indonesia, I can get into Malaysia. And they just can't afford the economies to slow down at any significant rate. That's why they're kind of going along with the program. But they're not going to go along much longer.
It's important to see China not as this all-powerful, omniscient country that is working out this master plan that will end with world domination. They're actually very nervous. They're kind of on a knife's edge because they have a history of instability. If you look at Chinese history for the last 100 years, it's been one civil war after another, followed by a dictatorship, followed by a long depression, and finally they're getting it together in a capitalist sense, but they're by no means there yet. Like you said, they have a lot of people who have expectations now. And they have to fulfill those expectations in the moment, in real time, in order to stay in power. And they need us. They need us to keep buying their stuff in the short run for that. And so they're willing to prop up the U.S. consumer-driven, debt-driven model for longer than otherwise would be rational for it to happen, because they need us for the time being. And they're very nervous about their internal situation. But the time will come when they're secure enough in their assets and in their finances that we won't matter to them as much anymore. And they'll be a lot less nice to us when that happens.
That's why I think Japan is so critical here, because there's a natural conflict between Japan and China. I mean, they have been at war and disagreements as long as the two countries have existed. Most recently, they're fighting over these obscure islands that are out in the middle of the China Sea. There's always natural conflict. And they're highly competitive nations. They see each other not as partners, but as threats. And so with Japan now completely committed to debasing the yen and driving it down, there's no questions about that. They see that as a direct challenge and threat to their economy. And so that's going to force China to take some action against what's being done by Japan in regards to the yen. And what that'll be, it's going to start with some very strong language, but it's the card it's not going to be America. It's not going to be Europe, in my mind, that's going to push them over the yen. They think they're playing us like a banjo and they're quite comfortable. Because we're almost predictable. But Japan is acting almost irrational and unpredictable right now. And that's because there's genuine fear in Japan of the magnitude of their problem. And it only takes, one irrational person to cause the problem. Does that make sense to you, John?
Oh yeah, completely. It would be interesting to hear what really goes on behind closed doors in the highest levels of Japan's economy, because they must see what's coming. they can all read balance sheets, and they know there's really no way out of this because the demographics are just overwhelming. They should have entered the period when their baby boom generation was going to retire with debt-free with a massive surplus. That's how a rational country would enter that period. And instead, they borrowed crazy amounts of money for the decade leading up to it. And so they've made their horrendous mistake, and they must see that there's no way out of it. And so it would be interesting to hear about how they're dealing with that, because obviously inflating away the value of their currency is one strategy, but they must know that that's not any kind of a solution. So it would be interesting to find out if they think they have a solution or if they're just trying to manage the decline for the next 20 years and just kind of fade into obscurity without a crisis, if that's their master plan. And I don't know, but I would hate to be one of the guys who are responsible for that country.
Last point I make, John, the biggest buyers of U.S. treasuries is Japan, other than the Federal Reserve. And even as broke as they are, they've been basically the only ones carrying the treasuries, as China has stopped. They're not selling, but they've stopped, and Russia's dumping all that they can. And more money, they'll help buy some of our bonds, but it's a tenuous position to be in. Last comments as we wrap this session. We're out of time, I see.
I think Japan definitely bears watching going forward, because the early effects of a really aggressively easy monetary policy a lot of the time are favorable. The Japanese stock market is way up lately. And presumably, if they actually get inflation up to 2% or 3% or 4% or wherever it ends up, that means their economy is going to be growing fairly dramatically in nominal terms, probably not in real terms, but they'll be putting up real numbers or what look like positive numbers. So it could for a while look like Japan actually has it together and they're turning the corner and they're growing and they're going to grow out of their troubles. But they're not. All of that is a monetary illusion, and we shouldn't be fooled by it. But at the same time, we should accept that they might have a decent year or two before they blow up, or they might blow up right away. And we're just going to have to pay attention in the meantime and be ready to act when it happens to, protect our capital however we have to, based on the way in which Japan blows up. So this is big, and we need to keep paying attention.
They're going to spend $100 billion in the next 15 months under ABE-nomics. That's going to stimulate something.
It is. So somewhere out there is the Austrian economics crack-up boom, a system that just goes parabolic at every level, where there's so much extra money flowing in that asset prices spike and stocks spike and the bond market goes crazy. And, maybe Japan will be the one. It's going to be a fascinating process to watch from the point of view of economic theory. If you're interested in this stuff, we're seeing case studies out there and laboratory experiments all over the place in these really arcane economic theories that you only get to see once in a generation because the fallout from them are so catastrophic. We're seeing a bunch of them all at once. So in that sense, we're kind of lucky to be living through this time. But only in that sense.
There must be all sorts of new subjects for the next book you're going to write.
Oh, there's no end to the stuff that's fun to write about here. I think historians are going to have a blast with this time, but with hindsight, you need some safe distance to really make sense of all of this. And so if I'm still around and writing 20 years from now, I would love to have a shot at sorting all of this out.
Could you tell our listeners how they could learn more about your writings, your site?
Yeah, I run dollarcollapse.com, which covers all of this plus the rest of the crazy stuff that's going on out there, updated daily.
That's the best way of describing it, crazy stuff that's going on.
Yeah.
I can't wait for next month to find out what we'll be talking about then. I was thinking last month we were talking about cyber wars, and now we're talking about cyber. I don't even want to speculate what it'll be on, but we are living in interesting times. We
really are. So next month, maybe Albania and Belize will blow up. Who knows?
Slovenia and Estonia.
Oh, okay. You're on record. Okay, Gordon. See ya.
Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.